Thanks. Thank you very much, everyone, for attending online today. I know we've received some questions emailed to us, and as Sam has said, if there's any questions about the presentation, please use the Q&A function, and Adam will read them out at the conclusion of the presentation. Many of you already have seen this, but essentially rent.com.au exists to make renting more rewarding. And by what we mean by that is that it's the whole experience of renting that we want to make better. It's not just about providing rewards points, but it's about empowering renters to provide them with innovative ways to pay their bond, rent, bills, and more, becoming the destination of choice for Australia's renters, who are a huge and underserved audience. Why renting? Well, it's a huge addressable market for us. The population is growing rapidly in Australia, and the population of renters, or the proportion of renters renting, is increasing as well. This has been a long-term trend, and we see it growing to the same as comparable countries like Canada and the UK, where you've got the mid 40% are renters. Already in our capital cities, we see that more than 50% of people rent. Predominantly, these people are fairly young. Our sweet spot of renter is between 25 and 35 years old. They are young professionals. They are definitely not sort of your poor, down, hard on their heels person. They're actually pretty well off, but are choosing to rent for logical lifestyle reasons. Importantly, they pay $85 billion of rent per year, and every month more than 200 million in bonds are lodged. To put that in context, we're right at the start of our monetization journey there. Currently, we do about $1 million of bond loans per month. So that's 0.5% of the market share. While we don't think 100% of all bonds will ever be financed, we know that there's still a lot of way for us to grow. More and more our business is geared towards focusing on renters who are in tenancy. And the reason for that is that's where 95% of renters are. Only 5% of renters at any point in time are searching for or applying and moving into a property. The other 95% are already in tenancy. And for us to make a meaningful difference to renting and make that whole renting process more rewarding, we need to focus more on the tenancy period. This has advantages for us as a business as well, because rather than the existing sort of transactional revenue streams that we get through rent.com.au, we can build solid recurring revenue streams through that tenancy period. Our products that we offer in that space today are Rent Bond and Rent Pay, and Rent Bond in particular it actually bridges the gap between the moving period and the tenancy period beautifully. And it provides the platform for us to then add further value through insurance, savings, investments, and other services. We've already made a step change in revenue across the course of this year compared to last year, averaging over $300,000 in revenue per month. A lot of that's been driven by Rent Pay. And as you can see on the chart on the right-hand side, that quarterly recurring revenue has doubled over the last year, with minimal impact from Rent Bond yet, because we've only launched that a couple of months ago. Predominantly, that is driven by the 66% year-over-year growth in Rent Pay revenues. Looking back in the last year, it's been transformational, and I know that word gets bandied around a lot, but we've really set a real strong platform for more growth. We're well capitalized. We have a $10 million debt facility from the LDM Income Fund. We've consistently executed against our strategy, and that has translated into share price growth, which provides greater access to capital. And we see that through the strong early exercise of options that has generated more than $5 million already. In total, that's given us a $12.5 million war chest to accelerate our growth to well past expected cash flow break even. As I've just touched on, we've also doubled recurring revenue, and that's been driven by Rent Pay. With Rent Bond now brought in-house, we're expecting to see that growth further accelerate through recurring revenues from Rent Bond. We've built resilience in our revenue streams. In the last quarter, 47% of group revenue was from recurring revenues, compared to a year ago where that was just 29%. By the end of June 2026, we're expecting more than 70% of group revenue to be from recurring sources. recurring revenue is a bit, I guess that's kind of the real secret and the source for us here. And that sets us up for another step change in revenue. Bringing RentBond in-house allows us to generate 6 times the revenue per loan compared to the previous model. And that just keeps compounding as we grow both customers as well as the overall loan book. We've already seen 27% revenue growth for the full business over year, and that rent bond has not yet played a big role in that. Overall, we're targeting a doubling of total monthly group revenue from the current base of 300,000 per month to about 600,000 by December 2026. Just a little bit on RentBond, and many of you will be familiar with this, but it is an award-winning renter-first product that solves a universal pain point. For me, it's a real indication of how our philosophy works. We've taken what is essentially a pretty standard product in terms of a personal loan, and we've tailored it to meet renters' specific needs and appeal to them. RentBond solves the bond gap. So where a renter has to put down 4 weeks worth of rent in terms of bond, they also have to put 2 weeks rent in advance down. And that's pretty sizable outlay in cash when they haven't had their bond released from their previous property yet. In addition to that, they can also cover moving costs and things like that. We don't take any security over that loan. Importantly, we don't get in the way of normal real estate agency processes. So we don't get involved with the government and have a fight with them over who owns the bond and things like that. It just works completely seamlessly, and that's been a big secret to its success. We've leveraged our existing capabilities to be able to launch this fairly quickly. We only got the funding approval at the end of May, but already by the end of July, we were writing our first loans. The reason we were able to do that so quickly is we've got existing management experience in consumer lending. We've got existing payments and compliance capability within RentPay. For many years, RentPay has had its own credit license. It is a financial product, so it's got an AFSL. It's a representative under an AFSL, and it processes more than $6 million in payments every week. Importantly for us, we also had existing customer demand. We've been offering RentBond for 10 years and have over 4,000 people applying for loans every single month. So we didn't have to go and find customers, we just had to convert them better, and we're on track with that. So the new things we needed to get were the debt facility, which we as I mentioned, agreed with LDM at the end of May and finalized that by the end of July. We've also added credit assessment tools from Experian, who are a market leader in this space, to complement the knowledge that we'd gained from over 10 years of offering RentBond. A key thing for us, though, is making sure that this product doesn't just work for rent.com.au. It absolutely needs to work for our renter customers too. Very pleasingly, since we've launched, we've yet to receive any bad ratings on RentBond. Predominantly, we get 5-star ratings because we are providing a genuine service, and we will continue to do that as far as we possibly can. As I mentioned before, we expect to earn 6 times the revenue per average loan compared to the model before. Previously, we used to earn just over $200 per loan in month 1. Now we actually earn revenue from a customer in January is still providing us revenue in December, and that keeps compounding. So month 2, month 3, month 4, month 5, etc., that revenue just keeps compounding, so that by the end of month 12, not only is on a per loan basis are we earning 6 times the revenue, but actually our entire group revenue is improving as well. As we can see, and look, I'm not comparing ourselves directly with the likes of Amazon and many of the other top 10 companies in the world, but most of those are built off solid recurring revenues. And so companies with solid recurring revenues can expect far greater valuation multiples than those with variable transaction sized revenues. Many questions I've been asked in sort of recent weeks and months is well, where can RentBond get to? Well, we're already seeing growth because we've got that current base that we've brought in-house, and that's been proven over 10 years of offering the product. But broadly, you can kind of think of the, I guess, sort of the axes along which we can expand RentBond as being sort of improving the margins and improving sort of product. And the other one is adding more customers. opportunities for us to optimize our existing customer base and get more of those 4,000 people per month into loans. So we currently only write about 300 to 400 loans per month out of those 4,000. So there's much better room for us to work there, getting smarter with our decision making, getting smarter with our user experience. We're looking at expanding and adding more partnerships. We already have a number of key partnerships in the industry that provide leads for us. We've recently started a trial with Gumtree, and they're rolling that out progressively across their platform. And we're in discussions with a number of large real estate portals for them to also offer Rent Bond to their customers. We haven't yet done any marketing around Rent Bond, but that is an opportunity for us. But we've got plenty of customers to be converting before we get to that point. But it is another lever, and there are other options as well. We've also, as a first-time lender, while we really benefit from the fact that we've got the facility through Aldian, there are opportunities as we prove up our capability in this space for us to lower that cost of funds. The capital that we've got through the options allows us to immediately start doing some of that, but there are further opportunities to keep lowering that cost of funds, which allow us to, and that falls straight to the bottom line in terms of profitability. We've got the opportunity to add other credit products in there and further product extensions as well, including cross-selling to other products that we offer in our platform, like utility connections, getting more customers using RentPay, and additional feature products that I've alluded to around insurance and savings, etc. That capital boost from the options really allows us to not only accelerate revenue, but it also brings forward positive operating cash flow through lowering the cost of funds immediately. Onto our other tenancy product, which is RentPay. Essentially, what RentPay is about is payment choice and flexibility for a renter. So, for example, what we mean by choice is we see a big proportion of the renters that use our platform choosing to use MasterCard, Visa, PayPal, etc., to pay their rent, rather than traditional forms like direct debit or bank transfer. Obviously, those are still available to people, but we're seeing that flexibility in choice really kind of shining. We also allow flexibility in terms of scheduling. So, for example, you may be a graphic designer that invoices your clients once a month. So the proposition to you is, when your clients pay you, why don't you keep your rent money aside in your RentPay wallet, and we'll make sure that the agent gets paid on time every time from that. Agents hate having to deal with dribs and drabs and inconsistent amounts of money and having to reconcile that. So we I guess, bridge that gap for them. On top of that, we provide cashbacks and rewards. Now, these are fairly vanilla offerings at this point in time, but we're looking at expanding those through additional partnerships to add more value to renters. The third offering for a renter at the moment is building credit score. In Australia today, your rent does not count towards overall credit. Even though you may be paying the same amount in rent as a mortgage holder, somebody with a mortgage gets a much better benefit from credit score than a renter does. So how we're bridging that gap is we've provided a line of credit to renters. It is optional, obviously. But if they have that line of credit, we report to credit agencies every month to increment their credit score. On the agent side, they get fast receipting, no dishonors. So we make sure that funds are 100% cleared before we pay it across to the real estate agents. And we provide batch receipting, which allows them to just upload that into their property management system, and it automates their trust account reconciliation. Through that, and by encouraging renters to prepay rent, etc., agents have less chasing that they need to do. And we've proven in a number of case studies that we can lower arrears to as much as 50% less arrears for RentPay customers than others. And because 25% of our users use the product without any agent intervention at all, agents can really position this to their renters as the payment app that renters want to use. We've had consistent growth in terms of both average revenue per user as well as overall customer numbers for RentPay. although I think it is no secret that we would like the customer numbers to be far greater. And many questions I've had recently have been around, well, do we need to persist with RentPay? The answer is unequivocally yes. It is a very big addressable market. As I've mentioned before, $85 billion of rent paid per year. We've had a look at this, and the opportunities for us are still similar to RentBond, are along adding more customers and improving the product and margins. We know that our platform is built, it works beautifully. We process more than $6 million of payments every single week. So that works. So any development we do need to do is purely margin accretive products that need to be added. Immediately, we've got a number of ways that we can improve our existing payment margins. We've been appointed as a consumer bill services provider, so that allows us to add a margin to credit card payments, which we haven't previously been able to do. We've done a lot of research around what some customer-led product extensions could look like. Things like share housing, introducing insurances, savings products, things like that are all on the table for us, and we're evaluating all of those. But probably a big area we haven't really tapped into yet is partnerships. If we look at sort of comparable businesses and certainly the early days of rent.com.au's growth, advertising and media partnerships were a big catalyst for growth in that space, and we kind of see similar happening with RentPay. On the customer axis, there needs to be greater alignment of price and value. And while that's a fairly vague term, allow me to explain that a little bit. What we have at the moment is a pricing structure that we've tried to match for both real estate agents and tenants on a simple $2 per month subscription, but everybody pays the same amount. Whereas we know that people are getting different value. We know that renters do not see the value in paying $2 a month for the benefit of a direct debit, for example, or a bank transfer, which are methods that they can use for free through their bank. So clearly they're not getting value through that. So we're not looking to charge them for that. However, where they do access choice in terms of payments, choice in terms of scheduling, and additional products and services that we're looking to do, we will introduce tiered products that allow them to do that. From an agency perspective, again, we need to provide value there, and we need to provide a simpler pricing structure, and we're exploring that. We see these relatively modest amendments being able to drive more customer growth, address any churn that we do have, and build a solid platform where we can then extend as we benefit from the improved margins, etc. We've got a great platform to build. Referral partnerships still play a big part in that, and we continue to work with agency groups for them to promote RentPay through their networks. We've never really done any consumer marketing around RentPay, so that is another thing that we've got on the table. But before we get to that point, we need to fix the pricing structure and make sure that we can provide a direct nexus between cost and value to a customer. Beyond that, there are other opportunities for us around adding customers to our whole network. We've previously spoken about these targets, and pleasingly, we're on track for them. We've said that we want to double our monthly revenue by the end of 2026, so Q2 FY27. We expect to see a doubling of our current revenues. By that same point, we expect to be positive from an EBITDA perspective for the whole group, not just the rent.com.au part of the business. And we expect more than 70% of revenue to be from recurring sources. The confidence we have around achieving those goals are we're already seeing through the 3 months that we've been offering RentBond, we're already seeing that on a per loan basis, we are generating around 6 times the revenue per loan. RentPay revenue is growing beautifully. Collectively, those are driving a doubling in recurring revenues, and we've added things like the data subscription from CoreLogic and other partnership revenue that is on a subscription basis. That's driven that 106% year-over-year recurring revenue growth. With an additional $5 million of option money that's come in over the recent months, along with the $6 million that we have from left undrawn in the LDM facility, we've got a huge war chest to accelerate growth and get us to cash flow positive within the near future. I'll now throw open to any questions. Adam, could you read them for us?
Thanks, Jan. We've received a number of questions from shareholders. I'll just go through them one at a time for you. First question comes from Andrew, and he asks, what is behind the early exercise of the RNTO options, and how does this change your plans?
Sorry, can you just repeat that question?
Question is, what is behind the early exercise of the RNTO options, and how does this change your plans?
Look, I think we've laid out and we've consistently been transparent around what we're hoping to achieve. The fact that we are executing against that plan, we're achieving what we said we would, I think has given people the confidence for us that we are going to execute on the future plans, and that's why they're getting in now at a reasonable price.
Thanks, Jan. The second question comes from Mark, who asks, will the money from the options affect your funding arrangement with Eldium at all?
Look, I don't think it affects the funding arrangement with Eldium. What it does do is it does allow us to, so today for every $100 that we lend to a customer, we're paying 15% interest on that $100. What we may do is start moving that down. So for example, we may contribute $20 out of that 100. If we do that, we reduce our cost of funds to say 12% on an average basis. 50%, 7%, that kind of thing. So it kind of allows us to keep the Eldium facility in place, but improve our margins from rent bond. It also allows us to start tackling product extensions. For example, we may introduce a line of credit or something like that. Those need to be proven up. We can do that with using our own funds, and we can bank all the profit from that without having to have that funded. At such point as we've proven up the business case, we can then make a compelling case to Eldium and other funders around them financing that and at a reduced cost of funds.
Thanks, Jan. The next question comes from Steve, who asks, rent bond is clearly driving momentum for the business. What is the role for rent pay going forward? Is it worth keeping?
Yes, is the short answer to that. Rent pay is definitely worth keeping. $85 billion addressable market, which we're only scratching the surface on. As I've outlined, product improvement, but yeah, we definitely want to keep it.
Thanks, Jan. The next question comes from Adrian, who asks, what has been holding back rent pay customer growth?
Look, a number of things. I think we've not marketed rent pay at all. I think we've also seen that there's churn from agencies, and look, it's a really tight rental market at the moment. The multiples that real estate agencies can earn from selling a rent roll are at all-time highs, and so we are seeing churn through agencies from agents selling rent rolls. That's difficult for us to combat, but having a clearer pricing structure and being able to market a valuable product to renters definitely drives us forward.
Thanks, Jan. The next question comes from Will, who asks, you've mentioned that the option exercise money takes you beyond cash flow break even. When is that likely to be?
Look, this money we're predominantly applying to grow both our profit and our revenue. As I mentioned before, through rent bond, we can actually get more of our revenue straight to the bottom line by funding some things ourselves, which obviously brings cash flow break even forward. The short answer to your question is we expect to achieve that within the next 12 months. So aligned with EBITDA profitability, we also expect that we would achieve cash flow break even within that timeframe.
Thanks, Jan. We have two more questions that have come through online during the meeting. And the first question is in two parts. The first part from Andrew reads, Gumtree was an excellent start. Without naming specific companies, can you comment on how many additional major rental or prop tech platforms are currently in late stage discussions for rent bond integration?
Thanks, Andrew. Look, yeah, thank you. We are pretty pleased with how Gumtree's going. That's only been in operation since late August, but so far so good. And we've actually expanded where they're offering. They're actually offering both rent bond and rent pay. We are discussing with at least 2 other portals and a number of other PropTech businesses. So we've got a handful of options to go forward on.
Thanks, Jan. And the second part of Andrew's question, can you comment on whether any new rent bond integrations, either pilots or full launches, are expected to go live this quarter or next?
Yeah, look, I think for us, the priority is actually we've got a lot of customers that we're not converting at the moment. So the priority for us is converting more of those. That doesn't mean that we switch off the pipeline of new opportunities. So the Gumtree one and optimizing that and getting more out of that is important. And then, back to the first part of your question, we're in discussions with a number of other players to keep that pipeline of new opportunities going.
Thanks, Jan. Final question that we've received online is a financial question from Jan. To calculate our gross margin on rent bond, is it reasonable to consider our revenue to be 30% interest plus $18 per month plus $400 establishment fee, offset by the 15% interest cost we pay to Eldium, and lower if we're able to self-fund the cash flow going forward?
Predominantly, yeah. I mean, we've got a calculator on our site that you can sort of play around with in terms of working out what the repayments on rent bond are. But essentially, yes, you're kind of in the ballpark there.
Thanks, Jan. We've not received any further questions.
Thank you, Jan, and thank you, Adam. Ladies and gentlemen, prior to the presentation by Jan, I'd like to take the opportunity to declare the meeting closed. The full results of the meeting will be posted onto the ASX announcements platform shortly. To the extent that there are any other questions that you have, please click on the Q&A button now and type it into the screen that pops up. Given that there have been no more questions submitted, thank you for your attendance at today's meeting and your ongoing support of rent.com.au. Thank you.